I couldn't hold on any longer and finally collapsed. The company I worked so hard to build has closed down. I never thought I'd become what everyone calls a debt defaulter. With over 3 million in debt, how can I possibly repay it?
In the past 5 years, I've spent 50 million on investments alone. I once was admired as a wealthy second-generation individual, but now I'm bankrupt and owe the banks up to 7 or 8 million, becoming a discredited person. I can't buy high-speed train tickets or fly on planes anymore. In this video, Mr. Zhang, who has been investing in several ventures since 2018, has experienced failure in each of his endeavors. Initially, he invested 2.6 million yuan in a bar that closed within 2 years. Subsequent investments in a hotspot restaurant and a late-night snack bar also ended when they had to be shut down after just a while. In retrospect, he views entrepreneurship as a trap, with a failure rate of 99.99%. In recent years, influenced by the pandemic and a challenging economic environment, numerous restaurants, physical stores, and factories have been shut down. Many previously successful business owners have gone bankrupt, becoming discredited persons that are subject to penalties, further causing banks' loan delinquency rates to rise and leading to more cautious lending practices. Consequently, banks in China now face a dilemma. They have funds available but cannot disburse them. Meanwhile, customer deposits are rapidly increasing, reducing banks' profitability. The clients who genuinely need loans are unable to secure them, which in turn affects economic growth. This vicious cycle has increased pressure on banks' lending capabilities and decreased their profitability significantly.
Even the banks are barely hanging on. They've been under great pressure about money recently, too. Deposits increased by 9.9 trillion yuan in the first quarter alone. Why are our wallets so tightened? No spending, no investing, no buying houses, not even thinking about spending money. Everyone's storing it all in the banks, and the banks are under immense pressure. My friends who work in the banks all look so worried, saying that while the deposit targets have been exceeded, only a tenth of the loan targets have been met. It's tough for banks. The money they manage to lend out always ends up circling back to them. Why is that? Some say it's because the economic situation is poor, making people hesitant to spend money carelessly. Others point to a lack of investment opportunities, with people struggling to find viable channels for their money. Some think it's because everyone has lost confidence, feeling that keeping money in the bank is the safest option. However, having all this money just sitting idle in the banks is not a solution. Banks need to find ways to lend this money out to support the growth of the real economy.
A man working in loan services named Mr. Zhao in Zhengzhou shares his thoughts and feelings. Everywhere online, they say banks cannot disburse their money, even though interest rates have been lowered, and there is high pressure to loan out funds. Bank managers are visibly stressed, yet in reality, securing a loan feels nearly impossible. With the economy faltering and gloomy overall climate, banks are apprehensive about lending to customers who may not be able to repay. The bank is like sandwich fillings, being squeezed in the middle, with policy pressure from above, market forces from below. Lower interest rates mean reduced earnings for banks. If they issue more loans, the risk increases, and banks fear losing money and getting into troubles. So they've raised the threshold for loans, wanting to lend only to those who seem reliable. So it's not that banks don't want to lend you money, but that they've become extremely cautious. They're worried you won't be able to repay, about losing money themselves, about regulatory bodies coming after them, and fear that too many defaults could jeopardize their jobs. On April 30th, China's state-owned banks reported their financial results for the first quarter of 2024, showing significant decline in both revenue and net profit. The big four state-owned banks, namely Industrial and Commercial Bank of China, Agricultural Bank of China, China Construction Bank, and Bank of China, are directly managed by China's Ministry of Finance. They have a total asset scale exceeding 160 trillion yuan, representing China's strongest financial capital. According to China's state media Economic Observer Online, the Industrial and Commercial Bank reported revenue of 219.8 billion yuan, a year-on-year decrease of 3.41%, marking the largest decline among the state-owned banks. China's Construction Bank and Bank of China also saw their revenues decrease by 3%. All four banks reported year-on-year declines in net profits, with Bank of China recording the largest drop at 2.9%. The other three banks saw their net profits decrease by 2.8%, 2.2%, and 1.6% respectively. American economist David Huang analyzed that China's banking system is not market-driven. He explained that China operates as a non-marketized interest rate economy, where the government sets the lending and deposit rate itself. Essentially, banks primarily profit from the margin between these rates, which are also determined by the government. This approach results in a banking system that is notably bureaucratic. Huang attributed the decline in revenue and profit of China's four major banks to five key factors. Firstly, banks have traditionally operated under policy-driven interest rate barriers, ensuring guaranteed profits primarily from small and medium enterprise loans. However, the interest rate margin has now narrowed to about 1.6 or 1.7. The slim profit margins, combined with the bank's historically extravagant spending, aggressive expansion, and bureaucratic business style, have led to a decline in profitability. The second factor is the lack of economic activity among the public. He noted that transactions such as transfers, purchases, and trades, which normally generate banking fees, have diminished due to the current economic slowdown. With China's economy in a poor state, opportunities for earning are scarce, leading people to avoid loans. This leads to a reduction in loan-generated income for banks, yet they continue to accept deposits and pay interest on these deposits, which further compress their profits. Thirdly, he mentioned that a significant portion of banks' past profits came from marketing and selling financial and insurance products. However, recent years have seen numerous failures in these products, reducing the public's participation and affecting profits. The fourth factor is the downturn in the real estate market, which has historically been a significant contributor to the profits of Chinese banks, particularly through developer financing and home mortgages. The major banks have a high proportion of mortgage loans in their portfolios. Currently, the real estate market is sluggish, and the overall market size is estimated to have contracted to about 60% to 70% of its previous volume. Huang points out that in the past, banks profited handsomely from increases in total loan volumes and policy support under a planned interest rate regime. Now, with the economic downturn and the slump in the real estate sector, the overall profitability of banks is expected to go downhill. About the fifth factor, Huang believes that the major cause of the simultaneous decrease in banks' revenues and profits is the increase in non-performing loan rates, including both credit card and mortgage loans. Many businesses defaulting or going bankrupt have led to a substantial rise in the bank's bad debt rates, therefore hampering profit growth across the banking sector. These five factors have led to a rapid decline in the profitability of banks, even resulting in negative growth. According to the 2023 annual report, the six major state-owned banks in China had a non-performing loan balance of 336 billion yuan. Of this, personal housing loans accounted for 36%, with a balance of 121 billion yuan, an increase of approximately 4.9 billion yuan from the previous year, raising the overall non-performing rate from 4.4% to about 4.7%. Real estate loans to businesses constituted 64% of the non-performing loans, totaling 214.5 billion yuan, an increase of about 16.7 billion yuan from the previous year, with the overall non-performing rate rising to approximately 5.24%. Real estate loans to businesses typically refer to medium to long-term project loans issued by banks for housing, commercial spaces, and other real estate developments. The collateral for these loans usually includes land, properties, and buildings under construction. Among them, the Industrial and Commercial Bank of China reported a non-performing rate of its real estate business loans of 5.4%, reaching 40.9 billion yuan. Non-performing loans in the category of housing mortgages increased by 9.6% to 27.8 billion yuan. The Agricultural Bank of China and the Bank of China, although experiencing a slight decrease, reported a non-performing rate in their real estate business loans of 5.4% and 5.5%, respectively, totaling 46.6 billion yuan and 48.2 billion yuan. The non-performing rate for real estate business loans at China's Construction Bank rose to 5.6%, amounting to 48.2 billion yuan. Economist Li Hengqing further analyzed the relationship between the collapse of China's real estate sector and the increase in bad debts in banks. He stated that the real estate sector once accounted for 30% of China's economic growth. With over 4,000 banks in China, entering the real estate sector was a core focus of banks during times of rapid development. He noted that the widespread collapse of the real estate industry has resulted in almost all loans to the sector turning into bad debts. As housing prices continue to fall, with some regions seeing reductions of up to 50% and common decreases ranging from 20% to 30%. The debt on these properties has become more valuable than the properties themselves. This situation has led to the creation of bad debt, making it unlikely that banks will be able to recover these loans. He said, many people simply stop repaying their loans because it no longer makes sense to do so. House prices in China are also expected to keep falling. In such circumstances, this has become a major issue and will eventually overwhelm a large number of commercial banks. Due to the continuous rise in overall non-performing loan rates among Chinese banks, Pan Gongsheng, the governor of the People's Bank of China, disclosed at the Bao Forum on March 27 this year that China is drafting a financial stability law. Experts suggest that the biggest issue for Chinese banks is the systematic depletion of assets, with the financial crisis looming as just a matter of time. Taiwanese economist Jia Longwu stated that banks rely on borrowers to continuously repay principal and interest. However, as the real estate crisis persists, the loans provided to real estate companies become non-performing assets. He said, from the defaults of major developers like Evergrande, Country Garden, and Vanke, it's conceivable that banks are next in line to face issues. He said, when banks issue the official list of the non-performing rate of real estate loans on their financial statements, we see that every single bank has to face this problem, which in itself represents a systematic risk. Jia Longwu noted, what we are seeing is not just one private developer in crisis, but almost all private developers are in debt crisis and unable to repay. Next, local governments and state-owned enterprises will face the same issue, all under significant debt pressure. When banks cannot recoup their money, the trouble becomes severe, which is why Pan Gongsheng has consistently emphasized the need to maintain the bottom line of avoiding systemic financial risk. He believes from large private developers to banks, a lot of money has been taken by those in power. After obtaining the yuan, they launder these corrupt funds to Hong Kong and overseas, essentially depleting assets. The real issue is the depletion of assets, which is underpinned by the abuse of power, lack of checks and balances, and insufficient supervision. He added, such a political system will inevitably lead to systemic corruption, systemic asset stripping, and ultimately systemic financial risk, which is inevitable and cannot be reversed by any single individual. The CCP's attempt to avoid these issues is futile. The New York Times also reported that nearly 40% of bank loans in China are related to real estate. Initially, the world's most indebted developer, China Evergrande, faced a financial blow-up followed by dozens of real estate developers who defaulted on or were unable to repay their overseas bonds. The then Vice Premier of China, Liu He, stated at the World Economic Forum in Davos, Switzerland in January last year that real estate posed a danger to China. If risks in the real estate sector are not properly managed, they can easily trigger systemic risks, necessitating timely intervention. Economist Cheng Xiaonong stated in his article that the survival of Chinese banks is closely tied to the regime's fate, with the Chinese Communist Party going to great lengths to prevent bank failures. In fact, China's financial system acts as the regime's last economic lifesaver. Fiscal debts are largely absorbed by banks purchasing bonds from local governments and state-owned enterprise SOEs, offload their bad debts onto banks. The only thing banks can rely on is government credit, leading the public to believe that the government will not let state-owned banks collapse. For this reason, to maintain the banking industry's reputation, banks are instructed not to disclose the actual numbers of bad debts nor accurately write down their assets. Thus, debt in China's financial sector is like a ticking time bomb, with the true scale of debt at major banks impossible to determine based on the books. Although the financial analysts in other countries cannot ascertain the full scope of these debts, indicators have led some to see traces of trouble. Recently, international credit rating agency Moody's detected financial risk in China and downgraded China's sovereign credit rating from stable to negative. It also downgraded the credit ratings of 8 major Chinese banks from stable to negative. These banks include the 5 major state-owned commercial banks: Agriculture Bank of China, Bank of China, China Construction Bank, Industrial and Commercial Bank of China, and Postal Savings Bank of China, as well as 3 policy banks: Agriculture Development Bank of China, China Development Bank, and Export-Import Bank of China. This negative assessment signals that potential risks in China financial sector are becoming more apparent. Under the Chinese Communist Party rule, the government treats banks like ATMs and always turns to banks for loans to finance fiscal shortages and cover losses of SOEs. Moreover, since 2010, local governments wanting a profit from real estate have issued a substantial number of bonds, with most being purchased by banks. In doing so, they have effectively joined the ranks of those bleeding the banks. China's financial iron rice bowl system has not changed. Instead, it has become a lifeline for local government survival. Even private real estate companies have learned to partake in this financial iron rice bowl, ultimately leading to a series of major real estate companies collapsing and thus bursting the real estate bubble. After the real estate bubble burst, enormous debts of local governments, SOEs, and private enterprises, along with massive bad debts from the public, concentrated the pressure on the banking system. To control financial resources, the CCP allowed only banks to go public to raise funds while keeping significant ownership of larger banks in its own hands, resulting in a crisis for the regime. As of the end of October 2023, the total loans on the books of national financial institutions stood at 235 trillion yuan, with bonds purchased totaling 64 trillion yuan, amounting to 300 trillion yuan combined. Officially, the recognized bad debt rate is 1.8%. However, considering that a large portion of local government bonds cannot be repaid, estimating a 50% bad debt rate for these and a 10% rate for corporate loans, the financial sector's bad debts amount to 56 trillion yuan. If the central and local government debts of 114 trillion yuan and the non-financial SOE debts of 220 trillion yuan are added to the minimum financial system debts of 56 trillion yuan, the total reaches nearly 390 trillion yuan. This is more than 3 times China's GDP. If China were likened to a large company controlled by the CCP, with annual revenues of 120 trillion yuan and debts of 400 trillion yuan, this company would be on the brink of bankruptcy. Recently, the practice of reclaiming salary has become more prevalent in China's banking sector, signaling a crisis within the industry. This phenomenon affects up to 10 publicly listed banks, including the Bank of China and China Merchants Bank, with the total involved in these claims approaching 100 million yuan. Reclaiming salary refers to situations where if employees engage in illegal, non-compliant, or disciplinary actions or expose the bank to abnormal risk losses during their tenure, the bank can partially or fully reclaim the performance pay issued during the relevant period and stop further payouts. This policy typically targets senior management and key employees in banks. On April 2nd, a credit department staffer from a city commercial bank informed reporters that in recent years, influenced by the pandemic among other factors, the bank's non-performing loan rate has risen, leading to some employees having their performance bonuses docked. An industry expert commented that a financial tsunami triggered by the CCP's banking sector's looming crisis is not far off. China affairs expert Wang He stated, "The crisis in China's banking industry is actually quite severe, especially with the ongoing issue of non-performing real estate loans. However, the data currently released by these banks themselves is essentially falsified, significantly downplaying the severity of the problem." He said, "Many banks not only have on-balance sheet operations, but also significant off-balance sheet activities, including many financial products that are actually invested in real estate. Now, through various accounting tricks, this is all being covered up. Due to the overall crisis in China's real estate, the entire banking industry is in jeopardy." Wang He believes that it is a widely shared view that a financial crisis in China's financial system is just a matter of time, and it is inevitable.